For most people, economic collapse looks loud. They imagine stock market crashes, empty shelves, panic on the streets, but the truth is far more uncomfortable. The most dangerous economic strategies don't begin with fear, they begin with confidence. They begin when governments say the system is working, when markets are calm, when people believe the worst is already behind them. Because by the time panic arrives, the damage has already been done. Welcome to the Financial Codex. This is not a news channel. This is not political commentary. Here we decode the hidden mechanics of money, power, and economic systems, the forces that quietly shape your future long before headlines catch up. In this video, we're breaking down an economic strategy that has been used again and again throughout history. A strategy that delivers short-term comfort, political relief, and market optimism, but almost always ends with long-term consequences. This isn't about opinion. It's about patterns. Let's begin. Strong economies are often most vulnerable at the exact moment they appear safest. This sounds counterintuitive, but history makes it clear. Economic disasters rarely strike when everyone expects them. They emerge when confidence is high, skepticism is low, and risk feels manageable. During these periods, warning signs don't disappear. They simply stop being taken seriously. Leaders point to growth figures, employment numbers, and rising markets as proof that the system is healthy. Media narratives reinforce stability. Investors reward optimism. Ordinary people adapt their expectations to match what they see around them. But surface-level strength can hide deep structural weakness. An economy can grow while becoming more fragile at the same time. It can produce impressive short-term results while quietly accumulating long-term stress. Growth alone does not equal resilience. What matters is how that growth is achieved. When growth is driven by productivity, innovation, and sustainable investment, it builds capacity. But when growth is driven by temporary stimulus, cheap credit, and deferred costs, it creates dependency. This is where illusion begins. Policies designed to stabilize the economy after a crisis often remain in place. Long after the crisis has passed, emergency measures become normalized. Temporary support turns permanent. What was once a response becomes a strategy. At first, this feels like success. Businesses survive. Markets recover. Consumers regain confidence. Politicians take credit. But stability built on support rather than strength behaves differently under pressure. Instead of absorbing shocks, the system requires continuous reinforcement. Any attempt to remove support triggers volatility. Any slowdown creates anxiety, because the system now depends on intervention. Intervention becomes politically unavoidable. Each cycle requires more effort than the last. Each adjustment carries greater risk. Over time, flexibility disappears. The economy becomes less responsive, more fragile, and increasingly sensitive to external shocks, even small ones. The illusion persists because the costs are delayed. Weakness spreads quietly, through balance sheets and incentives rather than headlines. By the time problems become visible, they are no longer isolated. They are systemic. And this is the moment when people realize that what looked like strength was actually dependence. To understand why these systems feel so convincing, you have to understand one simple idea. Short-term relief is not the same as long-term health. An economy can feel strong while quietly becoming weaker. Think of it like a sugar rush. When the body consumes sugar, energy spikes instantly. You feel alert, powerful, productive. But that energy isn't created, it's borrowed. And once the spike fades, the crash follows. Modern economic strategies often work the same way. When growth slows or uncertainty rises, governments respond with stimulus, spending increases, interest rates fall, credit becomes easier, markets respond immediately, stocks rise, confidence returns, headlines declare recovery. And for a while, it works. Businesses stay open, jobs are preserved, consumers continue spending. Politically, this is the best possible outcome. Pain is postponed, not confronted. But here's the hidden trade-off. Stimulus does not eliminate economic stress. It relocates it into the future. Debt replaces discipline. Liquidity replaces productivity. Instead of fixing structural weaknesses, the system learns how to operate around them. This creates a dangerous incentive problem. Once markets and businesses adjust to constant support, removing that support becomes risky. The economy stops responding naturally and starts reacting emotionally. Every slowdown triggers intervention. Every correction feels unacceptable. Over time, the system loses its ability to self-correct. This is why sugar-high economies last longer than critics expect. The effects feel real. Growth numbers appear healthy. Employment remains stable. Anyone raising concerns sounds pessimistic or disconnected. But beneath the surface, distortions are forming. Cheap money encourages risk. Asset prices inflate faster than real output. Debt expands not to build capacity, but to maintain appearances. Productivity growth lags behind financial growth. The gap widens, and the longer the sugar high lasts, the more painful the adjustment becomes. Because eventually, something changes. Interest rates rise, confidence weakens, external shocks appear, and suddenly, the system that relied on constant reinforcement has no buffer left. What once felt like strength now reveals itself as dependence. This is why sugar-high strategies are politically attractive, but economically dangerous. They reward the present at the expense of the future. They delay accountability. They create the illusion of control. And they train the system to expect rescue. When that expectation breaks, even slightly, volatility returns with force, not because the economy suddenly failed, but because it had been fragile for far longer than anyone wanted to admit. One of the reasons these economic strategies survive for so long is simple. The costs don't show up immediately. In fact, they often appear to disappear entirely. When pressure enters the system, through supply disruptions, policy shifts, or rising demand, businesses don't raise prices overnight. They absorb the shock. Margins shrink. Reserves are used. Inventory buffers soften the impact. From the outside, everything looks stable. Consumers keep spending. Inflation appears manageable. Leaders point to calm markets as proof that the strategy is working. But stability created by absorption is not stability created by balance. Every system has limits. When buffers run out, adjustments become unavoidable. This is where the delayed cost illusion becomes dangerous. By the time price increases reach consumers, the causes are already months or years old. Decisions made long ago finally surface as consequences today. But because the delay breaks the visible connection, accountability disappears. People react to symptoms, not origins. At the same time, labor dynamics begin to shift. Worker shortages push wages higher. This is often celebrated as progress, and in many ways it is. But wage growth without productivity growth changes cost structures across the economy. Businesses face higher expenses without producing more output. Again, the impact isn't immediate. At first, companies accept lower margins. Then they reduce investment. Eventually, they pass costs forward. This creates a slow, creeping pressure that doesn't trigger panic until it does. Another factor deepens the illusion: inflation measurement itself. Official numbers smooth reality. They average experiences. They lag behavior. By the time inflation becomes undeniable, purchasing power has already been eroding for a long time. For households, this feels confusing. Life becomes more expensive, but nothing dramatic happens all at once. No single moment signals collapse, just gradual adjustment, less saving, more credit use, higher dependence on stability continuing. And that dependence is the trap, because delayed costs don't disappear, they accumulate. Every postponed correction increases the scale of the eventual adjustment. Every ignored imbalance tightens constraints. The system becomes like a stretched rubber band. As long as pressure is applied carefully, it holds. But flexibility is lost. Small shocks cause disproportionate reactions. This is why economies that look calm can suddenly feel unstable. Not because something new broke, but because the margin for error vanished. By the time the public notices, options are limited, and the conversation shifts from prevention to damage control. Every economic experiment reaches a moment where belief replaces evidence. This is the most dangerous phase, not because the data disappears, but because confidence becomes the argument. Markets rise, headlines improve, and decision makers begin to interpret survival as success. But survival is not proof of sustainability. In this phase, warning signs are reframed as noise. Volatility is called adjustment. Debt is called investment. Delays are called strategy. And confidence feeds itself. Investors stay invested because everyone else is still invested. Consumers keep spending because employment remains stable. Policymakers double down because reversing course would signal weakness. The system becomes emotionally committed. At the same time, structural fragility grows quietly beneath the surface. Debt servicing costs rise as borrowing accumulates. Governments roll over obligations instead of reducing them. Corporations refinance rather than deleverage. Households lean more heavily on credit. None of this looks alarming in isolation. But together, it creates a system that functions only if conditions remain favorable. This is where confidence quietly turns into risk, because once expectations harden, flexibility disappears. Central banks face pressure to maintain growth even when inflationary signals appear. Political leaders resist restraint because voters are conditioned to short-term comfort. Markets punish caution faster than excess. So imbalance continues, not because it's invisible, but because confronting it is unpopular. History shows this pattern repeatedly. Late-stage confidence always feels justified. The numbers look good enough. The alternatives feel worse. And the belief that this time is different gains traction. But what actually changes is not the cycle, only the scale. Global interconnectedness amplifies outcomes. Supply chains transmit shocks faster. Financial markets react instantly. Capital moves at the speed of sentiment. This means corrections no longer arrive gradually. They arrive asymmetrically. Small triggers create outsized reactions because systems optimized for efficiency lose resilience. There's no slack left, and when confidence breaks, it doesn't fade, it snaps. The moment expectations shift, behavior changes rapidly. Spending slows. Investment freezes. Credit tightens. What looked like strength suddenly reveals dependence. This is why late-stage economic confidence feels calm, not euphoric. There are no fireworks, just normalization of risk. People assume tomorrow will resemble today because it has for a while. But stability based on expectation is fragile. Once the belief that nothing will change is questioned, everything changes at once. And that transition is never smooth. Every economic story ends the same way, not with a headline, not with a crash, but with a realization. A moment when people look around and ask a simple question: when did this become normal? By the time that question appears, the process is already complete. The adjustments that were delayed begin to surface all at once. Prices move faster than wages. Credit tightens. Growth slows not because opportunity vanished, but because confidence finally cracked. This is when narratives change. Policies once praised as bold are reclassified as reckless. Short-term wins are reframed as long-term costs. And responsibility becomes diffuse, spread across years of decisions instead of one moment of failure. But economies don't collapse from one mistake. They bend slowly until they don't. The most painful part isn't the slowdown itself. It's the loss of trust. Trust in stability. Trust in predictability. Trust that effort will be rewarded the same way tomorrow as it was yesterday. When that trust weakens, behavior shifts. People stop taking risks. Businesses delay expansion. Households save defensively. Innovation slows not because talent disappears, but because uncertainty dominates decision-making. And uncertainty is expensive. This is why economic consequences linger long after policies change. Systems remember stress. Balance sheets carry scars. Relationships take time to rebuild. History shows that recoveries aren't about growth rates alone. They're about restoring belief that the rules won't suddenly change again. That belief is fragile. It takes years to build and moments to break. This doesn't mean collapse is inevitable. It never is. Outcomes are shaped by choices made under pressure, whether leaders accept correction early or postpone it until adjustment becomes unavoidable. But postponement always increases the cost. The real danger isn't recession. Economies recover from recessions. The real danger is misdiagnosis, treating structural imbalance as temporary discomfort, and delay as strategy. Because math doesn't negotiate. Debts must be serviced. Costs must be absorbed. Resources must come from somewhere. Eventually, every system reconciles with reality. The only variable is how painful that reconciliation becomes. And that brings us to the quiet truth most discussions avoid. Economic experiments aren't judged by how they feel at the start, but by who pays at the end. Whether the burden is shared gradually or forced onto the future all at once. That choice defines generations. This story isn't about panic, and it's not about prediction. It's about awareness, because understanding cycles doesn't stop them, but it helps people survive them. And in the end, survival isn't about timing markets or guessing outcomes. It's about recognizing when confidence turns into complacency, and when comfort is borrowed, not earned. History is patient. The bill always arrives. So where does that leave us? Not with certainty, and not with fear, but with clarity. Economic cycles don't announce themselves. They reveal themselves slowly, through incentives, through behavior, through decisions that feel small in the moment, but compound over time. The story you just watched isn't about predicting the future. It's about understanding the forces shaping it. Because when you understand the system, you stop reacting emotionally to headlines and start thinking strategically about your own position inside it. That's what the Financial Codex is about. Not politics, not panic, just patterns, data, and the quiet mechanics behind power, money, and global decisions. If this breakdown helped you see the bigger picture, make sure you subscribe. New deep dive videos, no noise, no hype, just analysis that respects your intelligence. Drop your thoughts in the comments. Is this sustainable growth, or just another sugar high? And if there's a topic you want decoded next, a country, a crisis, a policy, let me know below. Because in a world full of narratives, understanding the code is the real advantage. I'll see you in the next one.